Welcome to our Thursday Greenleaf Connect event in partnership with the Greenleaf Foundation. Today, we welcome back our special guest, Jason Ford from Ford & Associates, and he'll be reviewing asset management with us, which is our second session in our financial literacy series this month. As always, we like to start with a brief explanation of what exactly Greenleaf Connect is. Greenleaf Connect is a weekly forum for us to be direct, informative, and provide transparency to our audiences about all things Greenleaf. Today's event is a Connect event, which means it's a more private group with videos on and live Q&A, while our live stream events are for larger groups and are open to the public. And for our rules of engagement today, first, you can change your presentation view by moving the slider between the presentation and the video to make the presentation or the video bigger or smaller. We do ask that you mute yourself during the presentation portion of our meeting to avoid any feedback as we present. And we will hold a live Q&A session at the end of the presentation, so be sure to think of your questions. And a friendly reminder that this session is being recorded and will be made available via Workplace by the end of the day tomorrow. On our agenda, Jason will start off with how money works and a nice refresher on the rule of 72 that we talked about last week. Next, he will explain mutual funds, what those are and how those work. Then we'll move into the 3 Ds of investing. And we'll end our presentation portion of today with a discussion on the different types of investment accounts. Finally, we close out with our live Q&A and some important upcoming dates. So without further ado, I want to introduce everyone to Jason Ford, who is a financial broker and coach with Ford & Associates. So welcome back, Jason.
Glad to be back, Natalie. How's everybody doing? Great afternoon, everyone. We're going to go ahead and dive in reference to that first principle, which is save as much money as you can, as fast as you can. Just know, as I go through the information on today, it's going to be a lot of information, but I don't want you to be overwhelmed. That is where the one-on-one coaching will come into play, where we can dive in a little bit more details. But I'm just going to give you like a high level on how your money works and how the investing actually works as well. So everyone heard my story before, so we're not going to go too much into that. So we can go ahead and dive into the next slide. All right, so how can you reach your financial goals and dreams? Just to recap, I'm on a crusade to help families create generational wealth. And there's 3 principles to wealth that we're going to be going over, but we're only going to focus on one today. That first principle is save as much money as you can, as fast as you can. The second principle is good, and we're going to talk on that next week, which is get out of debt as fast as you can. And then the last principle of wealth is you want to protect the wealth you have not yet created. And so we're going to discuss how money works. Next slide. So most people are concerned about money matters, but few truly understand how money works. So this is just a recap from last week. So your money should be working for you when you're not working, and it also should be working for you when you are. And it's very important that the hardest thing that should be working is your money. And when I talk about the investing, that's going to show you how your money needs to be working for you and not against you. Next slide. So as a recap, we talked about how you want to become an owner of your money, not a loaner. So when you get paid, you take your hard-earned money, you probably did like I did, put into your traditional financial institution, like your credit unions and your banks. And I was taught put my money into the traditional financial institution will put me in a position of creating wealth. But when I looked at my savings account and I looked at the interest rate on any CD that I had, I noticed my money was never growing. And the reason why is because what the financial institution will do with our money is take your money, our money, and invest it into the global economy. And so the global economy is just anywhere where you and I spend our hard-earned money. So on today, I'm going to show you exactly how you can take advantage of the global economy. Next slide. So all financial institutions know of a concept we're going to recap called the rule of 72. They call this rule the banker's rule, and I call it the money game rule. Because once again, if you don't know the rules that the financial institution is playing with your money, how can you win in the game of money? And I'm not sure if any of you all on last week decided to pull out any of your statements, checking account, savings account, 401ks. And if you did the division, take 72 and divide it by the interest rate. So for example, if you had a 4% interest rate, 72 divided by 4 is 18. So if you put $1 in that account today, in 18 years, it's going to double to $2. If you're able to see a 6% interest rate, 72 divided by 6 is 12. You put $1 in that account today, in 12 years, it'll double to 2. And if you're lucky enough to see a 12%, which I'm going to talk about that on today, 72 divided by 12 is 6. You put $1 in that account today, in 6 years, it's going to double to $2. Next slide. So let's use some real numbers here so it kind of makes sense. Let's say you had $5,000, and of course, we're about to come into tax season. So let's say you receive a refund of $5,000. So instead of spending it, let's say you took that $5,000, took it to your local bank or credit union, and they say you're our VIP customer, we're going to guarantee you 4%. Now, granted, there's no banks or credit unions offering 4%, but let's say they were. If you take 72 divided by 4, not percent, but the number 4, that's 18. So what that means is going to take 18 years for that 5,000 double to 10,000. So every 18 years, that money will double, because 18 plus 18 is 36. That 10,000 now doubles to 20,000. 43% of Americans, when they retire with less than $20,000 saved. And why is that? Because of small interest rate we're seeing on our money. So now what the banks and credit unions are going to do, they're going to take your money, our money, and they're going to invest it into the global economy. And the global economy over the past 50, 60 years has been averaging 12% or better. So now that same 5,000, 12% interest rate, 72 divided by 12 is 6. So every 6 years, as you see on the screen, that 10,000 is doubling. So in that same 36-year period, that $5,000 investment one time will double to $320,000 in 36 years. But at the 4%, we only receive 20,000. So the question is, who kept the $300,000 difference? Well, the banks, credit unions, and I'm going to show you how you can take advantage of the global economy, and you can do the same. Now, when it comes down to saving, the goal is to save up enough money so that when you're ready to retire, you can live off the interest of your money, okay? And when I talk about averaging 12%, it's not a guarantee. It's not a guaranteed 12%, it's an average. And for those of you taking notes, put on your paperwork that I cannot create wealth and guarantees. You and I cannot create wealth and guarantees. What I mean by that is if a traditional financial institution is willing to guarantee you a certain interest rate, that means they could make money off of your money to guarantee you whatever they guarantee you. Next slide. There's the rule of thumb that states that whatever you want to have annually, by the time you retire, you have to make sure you save up at least 10 times that amount between now and whenever you decide to retire. For example, if you want to have a $60,000 a year income, when you retire, you have to make sure you save up at least $600,000 between now and whenever you decide you want to retire. And the reason why you want to save up $600,000 is because you're only going to live off of 10% of that, living off the interest. Living off of 10% of $600,000 will pay you $60,000 a year for the rest of your life. And just know, retirement to me has nothing to do with an age. It has everything to do with you having options, meaning you have enough money saved up where you don't have to go to work unless that's something you want to do, not because you have to go do it. Now, let's say you want to have a $240,000 a year income where you don't have to go back to work when you retire. Well, you need to save up $2.4 million between now and whenever you want to hit retirement. So now that 600,000 and that 2.4 million that I went over, that represents your financial independence number, your financial independence number. And a lot of us do not know our financial independence number. We'll go work, but what are we working towards? So since everyone's number is going to be different, I'll be able to sit down with you and coach you on your number, and then I'll let you know exactly how much you need to be putting away a month to hit that number, because you have to know where you're headed. So just like we have a GPS that tells us how to go from point A to point B, you need to also have a financial GPS that's going to help you get from point A to point B. And so one question I always get asked is, well, Jason, where or where can you find a 12% average interest rate? Well, when it comes down to investing, you can invest your money in almost anything. Stocks, bonds, I hear people talking about crypto, real estate, and then they have something called mutual funds. Next slide. So what is a mutual fund? A mutual fund is designed where you have individual investors like you and I, and we are pooling our money together, and our money is being professionally managed by the mutual fund portfolio manager. So you have professional money managers that actually watch the money for you. So you don't have to sit there and watch it for you. Watch the money. They're going to watch it on your behalf. And then that money that you are putting into that mutual fund is being diversified or spread out over several different entities and industries. So when you're investing in a mutual fund, one mutual fund has up to, if not more than 150 companies in that one mutual fund. So you're going to have some technology, some real estate, some precious metals, entertainment, pharmaceuticals. You're going to have different entities and industries inside of that particular mutual fund. And it's different from purchasing individual stock. Because right now, I didn't have a chance to look at this, but if you decide that you want to purchase one share of Amazon stock, that's going to cost you a little over a couple $1,000s. But what if you found a mutual fund, and in that mutual fund, Amazon is a part of that mutual fund? So now you get a fraction of Amazon. Now you didn't get a full share, but a fraction of several hundred companies is better than not having access to any of those companies. Okay, so that is how a mutual fund works. And as a financial broker, I have access to 10,000 mutual funds. Okay, but not all of them are created equal. I just know based off of someone's risk factor, how aggressive or conservative they want to be will determine what type of mutual fund I put them in. Next slide. There's 5 great reasons on why you want to own a mutual fund. Okay, 5 great reasons. Number 1, professional money managed. So once again, you don't have to sit there and try to watch the money. Someone's watching it for you. And when it comes down to investing, and you're investing in these mutual funds, you're looking for long term. So number 1, it takes time, and you must be disciplined. Okay, it takes time, and you must be disciplined in order for this money to grow. So I don't want you to think, hey, we're going to put $100 in that account today, and then come the end of this year, I have $10,000. No, it's just going to take time. Okay. Number 2, diversification of assets, meaning you're not going to put all your eggs in one basket. It's going to be diversified. Number 3, growth potential, averaging that 12% or better rate of return. Number 4, affordability. I'm going to show you how you can invest with as little as $25 a month. So some people say, well, I thought I had to have a lot of money to invest. No, you don't. $25 is all it takes. And number 5, liquidity, meaning you have access to this money. Okay, you're not going to tie your money up into a contract. That's another thing. Never tie your money up into contracts like a CD or annuity. Why? Because contracts only benefit those who write it. And if you want to break the contract, like a CD or annuity, you got to pay a surrender fee. So we're going to set it up where you're not tied up into a contract. Okay. Next slide. When it comes down to investing, there are 3 D's to investing. 3 D's. 1 is diversification. 2, discipline. 3, dollar cost averaging. So number 1, diversification. Number 2, discipline. And number 3, dollar cost averaging. So I'm going to kind of highlight these 3 D's to investing as I discuss the tale of 3 investors. If you can go to the next slide. So here's the tale of 3 investors. Okay. So we have 3 investors on September 30th, 1972. These three families invested $10,000 into Invesco Equity and Income. That's a mutual fund. So they invested their money in Invesco Equity and Income Mutual Fund. 2 years later, their $10,000 went to $6,950. Okay, if this was your money, I know you all, everyone's on mute, but if you want to put this in the chat real quick, but if this was your money, how would you have reacted? If you put $10,000 in this account, and then 2 years later, you saw your money go to $6,950, how would you have reacted? I know some of you would probably been upset. Some may have said, hey, let me pull my money out. I told you I was going to lose. Others may have said, hey, let me keep put and let's see what happens. If you go to the next slide. So let's see what happened with the first investor, the Stevens family. So the Stevens family, they decided to play it safe and they take their money out and they put their money into a fixed account paying a guaranteed 3%. Remember how I stated earlier, you can't create wealth and guarantees. Well, they put their money to a guaranteed 3% investment vehicle. So now 46 years later, their $10,000 that went to $6,950 is now worth $27,578. So they had diversification, but they lacked discipline and dollar cost averaging. Okay, next slide. The next family, the Jones family, they decided to stay put. They said, well, you know what? I know it went down, but I'm going to stay put and let's see what happened. Well, 46 years later, their $10,000 that dropped down to $6,950 now grew to $689,820 in that same 46-year period. So they had diversification and discipline, but they lacked dollar cost averaging. Next slide. Then we have the Robinsons family. So what did the Robinson family do? Not only did they stay put, they also started adding $100 a month into this mutual fund. So now 46 years later, they have $1.4 million saved. So they lived all three Ds: diversification, discipline, and dollar cost averaging. So you may be asking, well, Jason, what is dollar cost averaging? Well, that's just a fancy investment term of stating monthly contributions. Okay, you put monthly contribution inside this mutual fund. And so you may hear some people, or you may have heard someone say, hey, I could time the market. Let me time the market. Let me wait till the market is down, then no one can time the market. So what dollar cost averaging does is when the individual puts in the $100, if the market is down, if the stock market is down, that's going to allow you to purchase more shares inside that mutual fund. If the market is up, you're going to purchase less shares. So since you never know when it's going to be up or down, doing dollar cost averaging helps when it comes down to investing. Next slide. I'm going to highlight just 3 types of investment accounts. There's several out there, but I'm going to highlight just 3. Okay. The first is a Roth IRA. And an IRA stands for an individual retirement account. An individual retirement account. And a Roth IRA is designed where the money you put in the account, you already pay taxes on it. So when it's time for you to pull this money out when you retire, you pay no taxes whatsoever. The Roth IRA is the only legal way you can retire tax-free. Now, the minimum it takes to invest with my firm is $25 a month. To open up any of these accounts is $25 a month. The max, if you're under the age of 50, you can put in $6,000 for the year inside the Roth IRA. If you're over the age of 50, you can put in $7,000 a year. And it's tax-free withdrawal at age 59 and a half. So that's the retirement age, 59 and a half. So at age 59 and a half, you can pull out the interest that your money has earned tax-free. Now your principal, whatever you put in, you can touch that money whenever you want. You don't have to wait to 59 and a half. Okay, you can touch that whenever you want, no questions asked. You just cannot touch the interest until you're over 59 and a half. And if you're over 59 and a half, yes, you can touch the interest, but also the Roth IRA must be open for at least 5 years. Okay. The second type of account is called a TOD. Now, the IRS title for this is called transfer on death. I really don't like that title, but that's what they call it. I call it a liquid savings account on steroids. Why? Because the money in the account is more liquid. You don't have to wait till retirement age before you can touch the interest. And it's on steroids because putting you in a position to average that 12% or better. Same with the Roth IRA. You can also average that 12%. The minimum you can put in there is $25 a month. The max, there's no limit. You can put as much money in this account as you like. But how do you pay your taxes? Because you got to pay your taxes. On this particular account, you pay your taxes based off of the interest your money earns that year. And you have to pay what they call the capital gain tax. The capital gain tax. Currently, the capital gain tax is 15%. Okay, so let's say hypothetically, an individual put $10,000 in this TOD. And let's say that year they earned $1,000 in interest. Around the second week in February, you're receiving your mail a 1099-R. It's going to state you earned $1,000 in interest. You then have to pay 15% of that $1,000 in capital gain tax, which is about $150. Now, with this TOD, one of the questions I got asked at one point in time was, do I have to wait till I die before I touch this money? No, you could touch this money whenever you like, okay, while you're living. The reason why they call it transfer on death is because when the client, the shareholder, passes away, whoever is listed as the beneficiary will get the money immediately, and you bypass going through probate court. That's why they call it transfer on death. And then the third account I'm going to highlight is for those of you that may have children, grandchildren, nieces, nephews, cousins under the age of 21. I'm going to talk to you about an UGMA account, UGMA. That stands for Uniform Gifts to Minor Act. Okay, the minimum you can put in there is $25 a month. The max, there's no limit. But how do you pay your taxes on this one? Now, the first $2,100 that you earn in interest, not what you put in, what you earn in interest is tax-free. Earning interest in a calendar year. Anything over $2,100 that is earned in a calendar year is taxed at the child's rate. Currently, the child's rate is approximately 10%. So let's say, for example, 1 year you earn $1,600 in interest. Since that's under $2,100, you pay no taxes. Let's say the next year you earn $2,000 in interest. That's under $2,100, you pay no taxes. Let's say 1 year you earn $2,600 in interest. Well, that first $2,100 is tax-free. The difference between $2,600 and $2,100, which is $500, is going to be taxed at the child's rate. So in that case, you have to pay 10% of $500 in taxes, which is $50. With this UGMA account, like it says, for any child under age 21, and the money can be used at any given point in time. But when money is being used in this account, it must be used to benefit the minor. All right, it must be used to benefit the minor, and they can use it for almost whatever they want. So they don't have to be just to go off to school. You can use it to purchase clothes, go on vacation, whatever you want to use the money for. It just must benefit the minor. Okay, it must benefit the minor. If you can go to the next slide for me. All right, so now I'm going to talk to you about an actual mutual fund. So here's, like I said, I have access to 10,000 mutual funds. I'm going to talk to you about this one right here, which is Invesco, which those three investors, this is the same mutual fund they invested in. Now, some of you may or may not heard of Invesco. Invesco, they are located actually right here in Atlanta, downtown Atlanta off of Peachtree Street. They've been around since the 1930s, and they are one of the largest private wealth companies in the world. And when I say private, they usually don't go after corporate dollars, like Fidelity and your Voyas. They like to go after corporations. Invesco like to go after you and I personal money. Okay, this particular mutual fund, they call it the all-weather portfolio. And the reason why they call it that is because this particular fund has won more awards than any other mutual fund that's out there. Next slide. So here's the 7 different asset classes. So remember I said you're not putting all your eggs in one basket. It's diversified over different entities and industries. So you're investing your money in some stocks, bonds, stocks, government bonds, international bonds, cash, and others. So you have a mixture of stocks and bonds. Because when the economy is doing well, you want to have stock corporations in your portfolio. When the economy is not doing too well, that's where the bonds come into play. And you see those 4 gentlemen down at the bottom. Remember with the mutual funds, I stated that it's professionally money managed. Well, those 4 gentlemen are the ones who watch the money 24 hours a day, 7 days of the week. Okay, so you don't have to sit there and watch it. They're going to watch it on your behalf. Next slide. In this one mutual fund, you're going to be investing in over 300 companies. So not 1, not 2, 300. So you're not putting all your eggs in one basket. 300 different companies. Next slide. Out of the 300 companies, these are just the top 10. I'm not going to show you all 300, but I can once we get together one-on-one. But these are just the top 10 of the 300. So you have some Bank of America, some General Motors, some Johnson Control, Philip Morris, Raytheon Technologies. Okay, so in this example, Bank of America represents 2% of this entire portfolio. So what does that mean? For every dollar that you put into this mutual fund, Bank of America only receives 2 pennies for every dollar. So if by chance, hypothetically, let's say Bank of America goes bankrupt, okay, you may be upset, but not too upset. Why? Because they only represent a fraction of your money. You didn't put all your eggs in one basket, if that makes sense. Next slide. So this is a true story, ladies and gentlemen, of a couple that they put $10,000 in this mutual fund back in 1961. They didn't add any money to it. They didn't take any money out. They let it sit from 1961, if you go to the next slide, all the way to the end of 2020, and it might be hard to read this, but if you look at the top right-hand corner of your screen, that will show you exactly how much money they have off of a one-time $10,000 investment. They have over $3.2 million. Now, between 1961 to 2020, would you agree there was probably some bad economic times in between those years? You probably would agree. If you go back one slide for me. So I'm going to show you exactly, if we were not investing in this particular mutual fund along these years, I'm going to show you rate of returns that we missed out on. Okay, so we're going to go back to 1961. If you look at the bottom of the screen, there's a purple line. If you look right above that, and I'm going to try to walk you through it, it might be hard to read, but if you look right above that, that shows you the rate of return they earned that year. So in the first year, 1961, they earned a 17% rate of return. The next year, they went down 7%, but cumulative, they're still up a positive 10. Then they went up 14, up 14, up 26, down 8, up 43. People are like, oh, where you get 12? Well, they did 43% that year, up 36, down 21. If you go through all these years, you may see about 10 or 11 negative years, and the rest are all positive. But I always like to highlight 2008. And if you go to the next slide for me. And it's hard to read this, but in 2008, this particular mutual fund did a negative 24%. And you heard a lot of people on the news say, hey, pull your money out, pull your money out. The market crashed. Well, that was the wrong thing to do if we were an investor and if we actually understood how investing worked. What we should have been doing is put more money in because we're purchasing more shares at a discounted price. So like if you go to the mall, we may not be looking for something that's marked up 30%. We may be looking for something that's on clearance. Or sort of like just a couple months ago, we had Black Friday. and Black Friday, everything was on discount, on sale. Well, guess what? In 2008, the market was on sale, which was the best time to go buy. Because look what happened the very next year. All right, in 2009, the market basically recovered, went up to 23%, up 12, down 1, up 12, up 24, up 9, down 2, and so on and so forth. So don't let what you see on the news scare you. You're gonna probably see some downs, but don't panic. The downs are kind of healthy for your portfolio, but just also know you're also gonna see some ups. And remember, when you're investing for long term, not for instant gratification. And it doesn't matter how young or how old an individual is. You can always start. We just have to start. I always share this story. My youngest investor is my 6-year-old daughter. She started investing with me when she was 4. And my oldest investor is my 96-year-old grandmother, and she started investing with me when she was 93. So it's never too late. We just have to start. And I want to be here to help you all reach your financial goals and dreams. Can you go to the next slide? So once again, here's my contact information. You can reach me via cell phone, email, and then in the chat, I'll make sure I put my calendar in there where you can schedule your one-on-one. I did have an opportunity already to sit down with Miss Vonda and help put some plans in place for her family. And she probably will tell you it was seamless. So we'll be able to sit down. I'll be able to sit down with you and coach you on your financial game plan. So I guess now, Natalie, we're going to open it up for any questions.
Great. Thank you, Jason. Okay.
Yes.
So thank you guys for joining us today. And Jason, thanks again. We always learn so much with our time with you. This does conclude the main portion of our presentation, but before we dive into our Q&A, don't forget to use Jason's calendar link to schedule your one-on-one coaching session with him. Again, this is free of charge to you. We'll put the link in the chat now, and it's also on Workplace on the Greenleaf Connect page for you guys to access there. And we will open it up to some pre-submitted questions that we have. Question: can you explain how 401ks work and what the difference is between this and other investment paths?
Yes, absolutely. So a 401k is an employer sponsored retirement plan. And so with the 401k, you have 2 types of 401ks. You have a traditional 401k, and you also have a Roth 401k. A traditional 401k is designed where the money that you put in are tax deferred. So you're not paying any taxes up front. But when you retire, you have to pay taxes on everything you pull out of that traditional 401k. Also with a traditional 401k, your contribution, whatever you're contributing into that traditional 401k could be a write-off when you're doing your taxes, but make sure you consult your tax person in reference to how that works. Now with a Roth 401k is designed where the money you actually put into the Roth 401k, you already pay taxes on that money. So that when you now retire and you start pulling that money out, you pay no taxes whatsoever. Now, with the Roth 401k, you cannot write off your contributions because when you retire, you're not paying any taxes. So that's the difference between the traditional and the Roth. Now, also with some employers 401k, and I believe Greenleaf is one of them, they actually have what they call a match. So where Greenleaf will match your contribution up to 4%. And so that 4% they'll match up to 4% of your salary. Okay, if you take your salary, multiply that by 4%, and that's going to give you a number. And you divide that by 12, and that's how much they're willing to match you. Okay, how much they're willing to match you, 4% of your salary, not to exceed. They match only 50%. So for instance, if you put in $100, Greenleaf will put in 50. If you put in $200, they will put in 100, but not to exceed 2% of your compensation. So when I sit down and coach you one-on-one, I can actually show you and go over those numbers with you. But that's the difference between a traditional 401k and a Roth 401k.
Okay. Our next
Oh,
question,
I'm sorry. I want to add one more thing.
yeah,
The max that you could put into a 401k, if you're under the age of 50, the max you could put in there is 20,500 for the year, 20,500. If you're over the age of 50, then the max you can put into a 401k is 27,000.
great. One other note on Greenleaf's 401k options, if anyone has any specific questions about our 401k plans, like how to sign up or how to change your current elections, there will be an FAQ flyer posted to our Connect recording post tomorrow in Workplace. So definitely check that out if you have additional questions. So our next question, Jason, do you recommend we have multiple areas of investments like IRAs and TODs, or should we put the money we can save into one area?
That's a great question. So most of the time I recommend that someone first focus on putting as much money as they can up to maxing out the Roth IRA. And then once you're able to max out the Roth IRA, which is 6,000 if you're under age of 50 or 7,000 if you're over age of 50, then we'll look into putting some money into the TOD. And then each one of those accounts will be designed where you're investing in mutual funds. So you still have access to the mutual funds. It's just we're going to either have the Roth IRA or the TOD. So to answer your question, I will focus on let's do as much as we can to max out the Roth IRA, but it doesn't stop someone to actually have both. You can have Roth IRA and a TOD. It all depends on how soon you're looking to access that money, because with the Roth IRA, once again, you cannot touch the interest until you're 59 and a half. But with the TOD, you can touch the interest, but remember, you have to pay the capital gain tax of 15%.
Right. Now for TODs, you did clarify for us that you can still use it even if someone hasn't passed away. But in
Yes.
case of death, once it is transferred, how do taxes work for the beneficiary if they want to pull out money, or what is their liability to hold the money?
That great question. So once that beneficiary has the money, they can cash that out, put it in their checking account or what have you. But if they keep it inside the TOD, if they transfer it, they get the money and open up another TOD that we're going to roll it over to, they are still responsible for that 15% capital gain tax. So even though they inherit the money, they still are responsible for following the IRS rules associated with a TOD. Same with if someone inherits an IRA. And with that IRA, let's say that person passed away, you now inherit an IRA, and let's say you're 45 years old. Well, you cannot touch the interest that Roth IRA has earned until you're 59 and a half. So you still have to follow the IRS rules when you inherit any type of retirement account.
Great. Now, if we already have an IRA account, let's say through a company like Fidelity, would you recommend we stay with that provider and evaluate our investment plan with them, or would you suggest a new provider to us?
Yeah, so what I'll do is just look at what you currently have with them, and what we'll look at it, we'll look at the fees associated with it, the costs, and then we'll see if it's beneficial for you to move over to another platform like what my firm can assist you with it. But I would need to take a look at it to see if it's number one, feasible, economical, and it's worth the cost to actually roll the money over. Now, whenever you're rolling your money from an IRA to an IRA, you don't pay any fees, you don't pay any taxes. But inside of those IRAs, there's fees associated for the maintenance. Because I mentioned earlier how those individuals have to watch the money. You do have to pay a one-time fee for them to watch it. So we just got to look at the dollars to see if it makes sense to actually move it or keep it where it's at.
Now, if it is a new provider, how does a rollover work?
Great question. So how a rollover works is you'll go back to your previous custodian that has your money, and you'll just let them know that you're looking to roll over your money to another financial institution. And at that point in time, you will ask that previous custodian, are there any forms you need to fill out to complete the rollover? And if there's any forms that need to be filled out, you just have them email it to you. And then someone like myself will help walk you through how to fill it out to successfully complete the rollover to go to the new financial institution.
And so as long as it's a rollover, there shouldn't be any tax implications for moving providers.
That is absolutely correct. The
But you
only way
said
a
there would
tax
be fees.
correct. So there will be a what they call a broker dealer fee, one-time fee, because now that those mutual fund shareholders, they're now watching the money. And so those four gentlemen I showed on that example, we have to pay them to watch the money to do what it needs to be doing. So you do have to pay a one-time broker dealer fee, depending on how much that individual is looking to invest. But to roll it over, you don't pay any taxes or penalties to roll it over. The only way you get penalized or have to pay taxes is if you don't roll it over, but you actually start cashing that money before you hit the retirement age. Then you have to pay taxes and penalties. But to roll it over, you don't.
Okay. And to confirm the mutual fund route, so let's just say if I want to take my current savings account money and put it into a mutual fund, you're saying that I can still use my money in the same way when I need it and all of that, and it's just as accessible with no fees.
That's absolutely correct. So what's going to happen is your mutual fund investment account, if it's, for example, the TOD, that's going to be linked to your checking or savings account. So therefore, if you ever need money, you'll log into your investment account and you transfer the money back into your checking or savings account. And then you have access to the money. There's no taxes, no fees, no penalties for you to roll the money back over. And you'll see that money back into your account within 2 to 3 business days, depending on your financial institution that you bank with.
Okay. Now, what if I want to put in more money than the max that's allowable through an IRA or a 401k?
Yeah, great question. So if you put in over the max, Uncle Sam is coming for anything over it. So you don't want to put anything over it because then you got to pay taxes on anything you go over. So once someone is able to max out a 401k or max out an IRA and you still have money that you want to invest, that's where the TOD will come into play because there's no limit to how much money you can put in there.
Great. So for the one-on-one coaching with you, so we can come to you with the available cash that we have for savings, and you'll advise us on what to do with it and where to put it?
That's absolutely correct. So based off of what you're looking to invest, and if it's money sitting in a savings account, I can then make some recommendation and say, hey, let's take some of this money and maybe we just put some of that money into a Roth IRA and then take another portion of it, put it into a TOD. Or we may say, let's put all of it into a Roth IRA. So depending on how much they have, I'll make some recommendations that's feasible for that individual, and we'll head them in the right direction.
Still on the coaching, what should we have together or prepare to make the most out of our first meeting with you?
Yeah, so on the investment side, if you already have like a IRA with another financial institution, if you can have that statement handy, that'll be great. When it comes down to the 401k, if you're able to get a list, let me back up. So as a broker, I have access to 10,000 mutual funds, but through the job, they typically do not give you 10,000 mutual funds to choose from. They usually give you maybe 20 to 25 to choose from. So what you can do is if you can reach out to your 401k provider and have them email you the list of the mutual funds that you have access to, then I can take a look at them and make some educate you on what funds you may want to look into putting your money into inside that 401k.
Great. So you also provided us with a client questionnaire. So just for the group that we will post that client questionnaire on Workplace tomorrow, and it will be helpful for you guys to complete that and send it to Jason prior to your meeting. That will be helpful for him to prepare. Okay, so we are now going to open up the floor to questions. So please use the raise your hand feature located under the reactions button at the bottom of your screen, and we'll get started answering your questions. So again, you can unmute yourself and turn your video on and just raise your hand. Okay, so Vonda has a question.
Oh, well, I can't do the video. Something's wrong with the video, but I do agree, Jason. I did get a chance to, oh, there we go. Thanks, Natalie. And more of a comment. I did get a chance for those on the call, work with Jason. Actually, after the initial presentation, it was very, very easy. And matter of fact, what he said, he jokingly said, take you about 15 minutes. I think we did it in about 5. So it was a pleasure. He was able to answer all of my questions. And if you're just getting to know me, I ask a lot of questions when it comes to money. So, but he was able to address all of them. And I what he did because he's actually helped financially for my daughter. So thanks, Jason.
You're welcome.
Great. Stephanie?
Hey there, Jason. First of all, thanks for all this great information. Sometimes talking about this could feel overwhelming and money, right? Easy is it? So if we put some, get with you and put some money into a mutual fund, how easy is it to like navigate our success basically? Like, is there a dashboard or is it updated, daily, weekly? How can we easily monitor progress?
Yeah, I think I heard you, even though it's going in and out on my end. Yes, you'll have online access to your investment account. And then once you have the online access, I can walk you through how to maneuver. It will show you how it's really easy to walk through it. You can add money whenever you like. You can decrease, if you do a monthly contribution, you can decrease your contribution whenever you like. You can increase your contribution. You can stop your contribution. It's very flexible once you get in there. It's real easy, friendly type of tool. So I can walk you through how to do that.
Great, thank you.
You're
On
welcome.
that's a great question, Stephanie. So like when you put us in mutual funds and different things like that, are you still our point of contact, or are now those 4 guys who we go to if we had questions?
Great question. I'm your point of contact. I love to do at least, I always tell people at the bare minimum, we'll talk once a year to do a portfolio review, but you don't have to wait till once a year. You have access to me whenever you need me. It could be every week, every month. I will be your point of contact that helps steer you to financial independence. So I'll be your contact, if not myself, one of my managers on the team, but right now it will be me.
Awesome. Well, I think those are all the questions that we have today. So I'm going to share my screen again and walk through some important dates that we have. So coming up tomorrow, this recording will be made available on Workplace. And also tomorrow we have with Stephanie our vision board exercise. Stephanie, that's still all good to go, right?
That's correct. And I'm
Awesome.
gonna put a Zoom link into the Workplace invite.
Great. Okay, so hopefully you guys will join us for that. And then Wednesday, we have our Tiny Pulse question that comes out, so be sure to answer that for us. And for our Greenleaf Connect schedule today, we held our second financial literacy series session on asset management. And then on Tuesday, we are hosting our 4th quarter 2021 live streams. And those will have a live Q&A session with our investors and our partners. So we invite all of you to join us for that. There are multiple, you will get calendar invites for those, but we have our multifamily review at 11 a.m., our commercial review at 2 p.m., industrial flex at 3, and then we close out the day with our retail review at 4 o'clock. And then next Thursday, we welcome back Jason again for our 3rd session of our financial literacy series. We'll go over debt solutions, and those are strategies to get out of debt. So for those of you, like we mentioned on our first call, if you're interested about the debt that you have, student loans, things like that, definitely join us for that session. And then on February 3rd, we have our 4th session with Jason on protection management, and that's protecting your income. And then you guys should have seen the calendar appointment move for our Oak Hollow sale update, and that has moved to the 3rd as well at 3 p.m. after our financial literacy session. And last but not least, a reminder on our new professional development partnership with a company called Kudo. You should have received an email last Friday with more details on the program, and it's also posted on the Greenleaf Connect Workplace page if you missed it. And then tomorrow you will receive your individual logins to the system along with the user guide to navigate the platform. Again, the program's free of charge to you. You'll have your own personal online account to take courses, and your course access is over 800 online courses that you can choose from language classes to communication skills and software programs. So lots of options out there for you. And best of all, there will be a Greenleaf completion incentive program for the courses that you complete. So stay tuned for more information here. So thank you all again for participating in today's session, and we look forward to seeing everyone next week for our third session of our financial literacy series, where Jason will dive into more details on debt solutions. So thanks again and enjoy your day.